Hi, we are now discussing about external financial reporting, which is CMA Part 1 syllabus. The first unit, Study Unit 1 and Topic A. So we are studying CMA Part 1, Study Unit 1. The topic is A, in which we discuss about external financial reporting. Here we are using the term called financial reporting. Financial reporting externally. So we have a reporting internal as well as external. As a management accountant, you are expected to give the reports internally to the management to make decisions, so that you can take decisions based on the performance management, cost control, risk management, etc. As an accountant, you are allowed to provide this financial reporting externally. This is called financial reporting externally, and management accountant internal reporting. But as a management accountant, you should know also the external financial reporting, which is mandatory in the US to provide it to the Securities Exchange and Commission, which is SEBI in India, same like SEBI in India, which regulates all public and private companies in the US. So all the US-based companies are performing their activities in the US or outside the US are mandatorily submit their financial reports to SEC every 3 months, every 90 days. And these are all to be signed by the CEO and CFO of the company. So we should know the standard format of external financial reporting. External financial reporting consists of the financial statements. A financial statement shows the financial performance and financial position of a company for a given period of time. The period of time is called a financial year. In the US, we follow the financial year, a calendar year, which begins on 1st of January and ends on 31st December. During this period, we must record all the transactions of the business, summarize and prepare the statement format to show the performance and financial status of the business. These statements are used by the users of the financial statements. The users of the financial statements can be internal, can be external. Internal users of the financial statements include the management, employees, investors, shareholders, etc. The external users of the financial statements include the regulatory bodies like Securities Exchange and Commission, tax authorities, concerned government, the state government, the portfolio managers, stock exchanges, and any potential investor. So keeping in view of internal and external users, we prepare financial statements. As these financial statements are presented to the external users, obviously the financial reports are to be prepared in a standard format, which are accepted by the various departments. Therefore, we should know the importance of the standard format of the financial statements, which are accepted by external parties. The standard format include the income statement, the balance sheet, the cash flow statement for any kind of business organization. The different types of business organization use financial statements in a standard format, like a proprietary company, single owner company, a partnership where 2 or more individuals can run a business. Still, they need to prepare the financial statements in a standard format to submit externally, internally. Corporates, limited companies, it's mandatory for limited companies for tax purpose and reporting purpose and to submit in the stock exchanges. We have different types of businesses here. Sole trading for business, which is run by one single person. There are some advantages, disadvantages of a sole proprietorship. Advantages include a business can be immediately started. A limited capital is enough. No regulatory pressure, and he can enjoy the profits. A single owner can enjoy the profits. But there are some disadvantages in the case of sole proprietorship, wherein the sole proprietor faces an unlimited liability. Unlimited liability means in the case of heavy losses continually, the sole proprietor may not be able to run the company wherein his assets are less than his obligations. What he has is less than what he has to pay the outsider. The liability is called obligation. So liability portion is higher, asset portion is lower, so he may become insolvent here. He may not be able to pay these amounts. In that case, he becomes bankrupt. In the case of bankruptcy, the court of law will intervene and seizes all the assets, try to pay the liabilities. We have 2 million assets and 3 million liabilities. So there is a shortage of 1 million. This 1 million will be recovered from his personal property, which is called unlimited liability. So a sole proprietor faces unlimited liability. Not only that, as he can take decisions on his own, sometimes his decisions may go wrong. Next, even if the company is flourishing, making heavy amount of profits, he wants to expand the business, but due to limited liability, limited amount of limited amount of capital, he may not expand it properly. So there are some advantages and disadvantages in the case of sole trading firm. Now we are talking about our corporates here, in fact, but before that, let us even know about partnership firm. Partnership firm has a flavor of sole proprietorship, but it is the only difference in the number of people. The partnership firm is owned by 2 or more people who can run the business by contributing their efforts and capital. They share the profits as per the agreed ratio. One of the partner or all the partners can operate the business, but partners will face unlimited liability here, same like sole proprietorship. So there are some advantages, disadvantages in partnership form as well. But in the case of corporation, a limited company is made up of shareholders' capital in the form of shares as well as bonds, a debt capital and share capital, which are invested in the corporation. Shareholders' money is invested in the corporation. We call it as a limited company. Shareholders elect board of directors who operate the business, day-to-day operations of the business. Board of directors employ the officers, senior officers, who will employ the executives to run the business. How the corporation is different from the sole proprietorship and partnership? Here, in both the cases, we have unlimited liability in the case of sole proprietorship and partnership. But in the case of corporation, the shareholders have limited liability. What does it mean? A shareholder purchased a share for, say, $100. In the case of liquidation or bankruptcy, when company becomes bankrupt, becomes insolvent, assets in the previous example, assets are 2 million, liabilities of 3 million. Shareholder need not bring any amount from his personal property because his liability is limited to the extent of what he invested in the business. Unlike sole proprietorship and partnership, shareholders, liability is only limited to the extent of what the shareholders invest in the business. This is a great advantage to the shareholders of a limited company. They share the profits according to the number of shares, the profit divided by number of common shares, which we'll learn in the further classes. In cooperative societies, these business or operations operated by communities, wherein some members of the society will operate the business. It is purely based on non-profit organization. It can be easily set up because there are no regulations, no regulatory issues. But only thing is, as this is made up of many members of a community, a decision can be very difficult in this case. A franchise business, which is buying the rights from other companies, it can be easily formed. It is a hybrid form of the business. You have your own business, taking the rights from others to use their products and services. The advantage is that you get brand recognition. You can start the business immediately, and training and support will be provided by the owner of the company. The issue is here the disadvantage that you need to pay franchise fee or royalty fee, and the renewal of the franchise is subject to the agreement. Here, our subject in CMA is on corporations. Just to create an awareness, I explained you about sole proprietorship, partnership, cooperative societies, and franchises. Your concentration should be on corporations. A corporation is nothing but a limited company wherein the capital is raised by issuing the shares and bonds. A capital of a corporation is made up of shares and bonds. We have shareholders who purchase shares. We have bondholders who purchase bonds. Bonds are the debt instruments on which we pay interest. We means we are working for the corporation. We are the management accountant of the corporation. So we pay interest to the bondholders as agreed. And after the payment of interest to the bondholders, we pay tax, and the profit is distributed to the shareholders as dividend. Now, when we say that we raise a capital by issuing the shares and bonds, we distribute interest to the bondholders, dividend to the shareholders. To know this, we need to prepare the financial statements. What amount of profit is earned? What are the assets held by the company? What are the obligations we have in the company? Our financial statements of a corporate consist of income statement. We also call it as profit or loss account. Retained earnings statement, how the profits and losses are used in the business, how they are distributed, how they are retained in the business. We also call it as statement showing changes in equity. We prepare statement of financial position. We call it as balance sheet to know the financial position of a company. We prepared income statement here to know the profit of the company. We prepared balance sheet here to know the financial position of a company. But where did cash come from? Where did cash go? Is ignored from these three financial statements. So there should be a statement which gives answers to these questions. The sources of cash and the application of cash. The sources of cash is called as cash inflow, and the application of cash is called as cash outflow. So inflow and outflow of cash is explained by a statement called cash flow statement, a statement of cash flows. We prepare these four financial statements. It is mandatory for a public limited company. These are to be authorized by CFO, CEO, and the external auditor of the company. External auditor gives assurance that yes, I have verified these financial statements. They're all accurate as per my knowledge. CFO and CEO agree the financial statements accuracy. the accounting principles used in the preparation of financial statements, and these financial statements are submitted to external parties. That's the reason why the topic is called as external financial reporting, which consists of the preparation of income statement, retained earnings statement, statement of financial position, and statement of cash flows. This is the order of the preparation of financial statements. Because they are interdependent, therefore the order should be same. What is the interdependency? The interdependency here is that we prepare income statement and the output of the income statement, that is net income, is transferred to the retained earnings statement, wherein we discuss what amount of net income is paid to the shareholders as dividend and what amount of the net income retained in the business for future expansion, which will become equity in due course. So the output of income statement is transferred to retained earnings statement, wherein we show what amount is distributed and what amount is retained in the business. The retained portion will become equity and will be added to equity in the balance sheet. Therefore, after the preparation of retained earnings statement, we prepare statement of financial position, which shows that what we own and what we owe. What we own are assets of the business and resources of the business. What we owe are the liabilities of the business, which are obligations of the business. These obligations are of two types: the liabilities to the internal parties, the shareholders, bondholders, etc. The liabilities to the external parties, like sundry creditors, any outstanding expenses, taxes due, provisions, etc. Therefore, the balance sheet consists of what we own, what we owe to the external parties, and the owners of the business. So what we own equals to what we owe. This has to be tallied with the balance sheet. That is, assets equals to liabilities plus equity. Liabilities is a portion of external parties and equity is a portion of the internal parties like shareholders. Then we move on to the cash flow statement using the information from these three statements. The information which we presented in these financial statements will be used in the cash flow statement, wherein we show that what are the cash inflows and what are the cash outflows. We have a separate section on cash flow statement. It takes at least 2 to 3 hours of time to prepare cash flow statement. In detail, we will discuss about cash flow statement, how to prepare to know the cash from inflow, cash to outflows. Then we mention here notes to financial statements. While presenting the financial statements, it is very important that the notes of the financial statements are to be attached along with the reporting. Financial reporting without notes of the financial statements is incomplete reporting. What do we show in notes to the financial statements? Companies use different methods. Companies use different principles. What methods we used in the computation of the income, in recognizing the revenues, in recognizing the expenses, in the treatment of management remuneration, in the treatment of the valuation of inventory. These are the examples need to be shown in financial statements. Not only this, we have a lot of other important points to be mentioned in the financial statements, which we'll discuss in the further classes. So at the moment, the financial reporting consists of the preparation of income statement, retained earnings statement, statement of financial position, statement of cash flows, and adding the notes to the financial statements. The financial statement report begins with income statement. An income statement shows the performance of a business for a period of 1 year. We report on a yearly basis, but to the management, we prepare the financial reports on monthly basis. For external reporting purpose, we need here 12 months. But as it is a public limited company, for every 3 months, we prepare our management reports to SEC, Securities Exchange Commission, so that SEC monitors whether all the accounts are maintained properly or not. This has to be done for every 3 months. So we are preparing income statement to see the performance of the business for a particular period. It can be a month or quarter or a year. When you prepare income statement, you consider only the temporary accounts. What are temporary accounts? Temporary accounts are called nominal accounts. What are they? Nominal accounts consist of revenues and expenses. Why do we call revenues and expenses as temporary accounts? These two are called as temporary accounts because the expenses are matched with the revenues and the difference will be transferred to the equity. The difference will be enjoyed by the shareholders, bondholders. Here you have a revenue portion of say 1 million and expense portion of say example of 800,000, 0.8 million. So you have a difference of here 0.2 million. This is called profit. Here we close the revenues with expenses and only see the difference here 0.2 million, that's $200,000, which will be transferred to next statement called retained earnings statement. These two accounts, revenues and expenses, will not be carried forward to next period. Closed here, and the difference is called net profit or net income that will be transferred to retained earnings account. This is the reason why revenues and expenses accounts are called temporary accounts. Revenues and expenses we'll discuss in detail in a multi-step income statement. An income statement can be prepared in two methods: single step method, multi-step method. A single step method is used by the businessman, usually the sole proprietors or partners, because they do not want the detailed information of the income earned at various levels. This is the reason why it is not allowed for external reporting. A single step income statement is not allowed for external reporting because it does not give the complete details of the profits earned at different stages. A multi-step income statement is allowed for external reporting. In multi-step income statement, we can find the gross profit, but not in the single step income statement. A single step income statement format include the revenues, total of revenues minus total of expenses. There's no segregation of expenses like how much we spent on admin, selling, distribution, how much we spent on cost of the goods. If these details are not available, the shareholders may not be happy that what is the profit we earned just by buying and selling the goods, how much we spent on admin, how much we spent on distribution. Therefore, the single step income statement is not much popular, wherein even not the gross profit is shown there. This is the reason why it is not allowed for external reporting. Let's take the format of income statement. Income statement in multi-step. While preparing multi-step income statement, we should understand always that what is the standard format of income statement? Therefore, if you know the standard format, whether you are a science graduate, engineering graduate, or accounting graduate, okay, you can start from learning from scratch. So whenever you prepare any financial statement, remember these three sentences: company name, name of the company, name of the statement, and the period for which you are reporting, not the date on which you are reporting, the period for which you are reporting. Name of the company, name of the statement, and period of reporting. So here we are preparing income statement, multi-step format, giving the amount in the currency, reporting currency. As we are discussing about the companies, US companies operating outside the US, so think in view of multinational companies. You will have reporting currency, you will have local currency, which we call it as functional currency. So when we are preparing the financial statements for external reporting, always the currency should be presented in reporting currency. And also there should be a rounding off policy, like when we say 1 million, we will not write last 000, we mention it as common. Okay. We begin with net sales, which is a revenue. Our revenues in the case of our retail industries, the sale money of the goods sold. Our revenues in the case of service companies, the revenues generated by providing the services. Deduct the cost of the goods sold, what cost you incurred on the goods sold, to get the gross profit. So the difference between sales and cost of goods sold is called as gross profit. And deduct operating expenses, which include admin, selling, and distribution. The operating expenses consist of admin, selling, and distribution. Deduct from them, you get operating profit. Operating profit of the company shows the efficiency of the manager, to what extent the incentives he will get for the operating profit earned for a particular period of time, which is the difference between cost of gross profit and operating expenses. Then the next cost is interest. Interest is also known as finance cost. This is on the amount borrowed, like bonds or bank loans, on this finance times the rate of interest. Interest expense is a non-operating expenditure. It is not spent for the operations of the business. That's the reason why it is not to be included under the head operating expenses. It's a non-operating expense. It has to be deducted only from the operating expense, operating profit. So interest expense will get EBT. EBT, earnings before tax or profit before tax. This is subject to tax. In taxable countries, a tax rate will be applied as per the prevailing rate, say 40%. So 40% of EBT will be deducted here to get net income. This shows the performance of the company for a particular period of time, say a year or a quarter or a month. Our net income is distributed to the shareholders as dividend, but not 100%. A remaining portion will be transferred to retained earnings. So a portion of net income is distributed as dividend, and the remaining portion is called retained earnings, which will be added to the capital to become equity. This we'll learn later in the next class.